Now, we've seen a big increase just in 90 days or so. The 10-year Treasury has gone up by well over 100 basis points. We've gone through a period of exceptional monetary policy, and now we may have to go back to normal. Will going back to normal be a very painful process?
I think it really depends on the pace at which that return to normality is executed. If you listen to what the Fed has been saying, they have been very clear that the pace at which they intend to return at least their interest rates to normal will be driven very much by the incoming data and by whether or not their forecast of a return to normal growth is borne out. And so I would say it doesn't necessarily have to be painful, the return to a normal yield curve, normal 10-year. It depends very much on whether that's a reflection of surrounding macroeconomic conditions or it's a reflection of some short-term panic or concern in the markets.
Do you think it was a mistake to use these exceptional monetary policies for so long because they continued well beyond the financial crisis?
The truth is no one really knows yet, right? History will tell us, and that's often the case with any kind of policy maneuver that's been used or policy move that has been used. We do know that some individuals were very concerned about inflation as the Fed expanded its balance sheet and kept interest rates really low for a long time. To date, we don't see a broad pickup in inflation. We also know that individuals have been concerned about asset bubbles of one sort or another. Folks who are watching this say there are many asset classes that are probably fully priced, but we don't yet see evidence of bubbles. So I would say so far so good, but this is the kind of thing where history will give us a lot of perspective that will be important in making judgments.
Right. One area that's been very much in the news are the fiscal problems of states and municipalities, and there's been a lot of pressure from kind of the free market folks and the budget cutters to move to defined, and it's mainly a pension problem.
Right.
So I know you're working on some plans that are very interesting, and some specifically in a few states to do a hybrid so that you can get the unions on board, but you also can move more to what corporate America has, the type of pension plans that corporate America has. Can you tell us about that campaign?
Absolutely. We have introduced into the market for state and local governments what we describe as a managed DC plan, a risk-managed DC plan, or a hybrid plan, and it has the best of a defined contribution world and the defined benefit world. The defined contribution part is that it has contributions from the workers, the employers, as well as from the state government or the municipal government. The hybrid is that it then brings in a defined benefit component, in our case in the form of an annuity that will guarantee income for life. We add to it a couple of very important elements that a DC plan, a defined contribution plan, has not historically had. One is mandatory participation and recommended savings rates. And then we also add advice, objective advice in our case, so that individuals can create a portfolio and asset allocation that reflects appropriately their risk tolerance and also their age.
Right, and are you finding that both sides, the government side and the union side, are willing to buy in for these types of plans? Do you think they're going to spread?
Well, we do expect them to spread because we believe these are the right things to do. The advantages that they have are for those who want to make sure that the government's liabilities are predictable and capped. This will help do that. On the other hand, for individuals, let's say in the unions, who want to make sure that there is a defined benefit that makes this a real retirement plan, these hybrid plans offer both. So we think there is something in it for everybody.